This is A Tax Lawyer Answers the Internet. My name is Edward Collins. I'm a lawyer specializing in tax, estate, and business law, and I'm also a serial entrepreneur with multiple companies that I've built and scaled over the course of the past 26 years. And I've been helping business owners just like you to navigate the landscape that is financial literacy for business owners so that you can navigate around the potholes and pitfalls that so many fall into. Each and every day, my community sends in a ton of different questions that are really on the top of minds of business owners just like you. So I figured, why not try to answer some? Let's dive in. Should you increase your contributions into a 401k plan, or should you increase your tax withholdings so that you end up paying less taxes at the end of the tax year? I think that this particular question misunderstands the nature of those two very, very different things. You see, a 401k contribution is going to be reducing your taxable income, and it will actually result in a lower tax amount due. The concept of increasing your tax withholdings is essentially telling the IRS that you're going to prepay them on the taxes that may or may not be due at the end of the year. I really never want to do that. I want to try to pay the absolute minimum that I'm required to pay when it comes to taxes, pretty much at any point in time that I'm paying them, whether that's through a withholding that's happening on a regular per pay period basis, or whether for most business owners paying on a quarterly basis, how am I able to pay the minimum possible? And a lot of that has to do with planning. When you're developing a strategy, the plan that you put in place is critically important. What are you going to be doing to reduce your overall tax burden? A 401k contribution is a reasonable step to consider, but the challenge with the 401k contribution is that you are essentially just deferring the tax bill, meaning you're going to make a contribution today in order to reduce your taxes today, but you're deferring the tax event down the road, and hopefully the tax rates would be lower at that future point in time. But when I'm teaching business owners, I'm teaching them never to be hoping for lower taxable income in the future. What I'm helping them to do is to figure out how to reduce their taxable income through strategies, whether that's this year, next year, in retirement, whatever it may be, so that their tax burden is lessened. When it comes to prepaying taxes, well, I'm never going to do that, because at the end of the day, that's a tax-free loan that you're giving to the government, and they would never do the same. So how should you buy assets? Should they be purchased in your own name or in a business name? I teach something called the real wealth matrix, which is the ideal hierarchy of ownership pretty much over everything in your life. And we utilize trusts, holding companies, and operating companies in order to create this framework that has three objectives. One, to provide an estate planning overlay. Two, to create a layered entity structure that adds the opportunity for you to get significant asset protections. And three, to create an infrastructure upon which to layer tax reduction strategy. But I don't want your name on public record at all. If you were to ask me, how should you actually acquire assets, those things which you're going to control that will generate cash flow for you, I never want you acquiring them in your own name. I would much rather you acquire them in some form of structure that creates the ability to leverage those three objectives. When acquiring a subject to property, how do you, as the acquirer, actually take advantage of all the tax incentives that are associated with real estate? Well, the reality is there is almost no difference between whether you acquire a deed in a traditional method with regard to going out and getting your own financing and paying for that particular deed in the transaction, in the actual closed transaction itself, or going and handling the exact same event, but just subject to an existing mortgage. The reality is this. Either way, the transaction occurs. You own the deed. The deed has transferred from the original owner to now you. And as the new owner of the property, even if it is subject to a pre-existing mortgage, you still get all of the tax benefits that are associated with that property, including the coveted depreciation. How does leveraging an accountable plan and taking a deduction under that inside of an S-Corp differ from just writing off the business expense as a sole proprietor? The reality is the accountable plan is essentially a way of avoiding or minimizing your exposure to something called an audit. Why? Because the accountable plan is simply a reimbursement plan. And when you form the S corporation, you're able to leverage it because it actually creates the scenario where you are both an owner and an employee of your business. And there's a section in the tax code that allows for reimbursement arrangements to be created for the benefit of employees. And in your S corporation, under what we teach inside of the up-level community called the Real Wealth Matrix, inside of that framework, the S corporation exists at the holding company level, which means there's no other employees there. You are the only employee, and you are getting this reimbursement plan, this benefit, in such a way where the business gets to take a tax deduction for that particular expense, and you as the employee get to receive that expense reimbursement income tax-free. Now, the important part to understand, though, is the main difference is not necessarily the deduction you get for the business expense. The main difference is in the S corporation arrangement, you also get the added benefit of reducing your exposure to self-employment tax. And really, that's where the power lies in that particular strategy. What strategies are necessary for you to be able to offset W-2 income with any losses that may be associated with the income-producing properties? The strategy specifically that so many people are leveraging is a strategy where you take advantage of something called bonus depreciation. Real estate, by default, is going to be considered passive, and therefore it has to adhere to something called the passive activity loss rules, which state that losses that occur in passive activity can only be used to offset passive income. So think in the context of a rental property. Getting a passive loss in that rental property could only be used to offset the rental income. But if you are also a high earner, W-2 earner, if you will, you may wish to be able to take some losses that would be otherwise passive and apply them against your W-2 income. And the only way to do that is to qualify for an exception to the passive activity loss rules. And there's really two main ones. The first is something referred to as the real estate professional status, which requires you to engage in the trade and or business of real estate. And there are 11 criteria for that, but that would mean you'd have to engage at least 750 hours a year in that type of activity, and it has to be the majority of where you spend your time. So W-2 earners, almost in every circumstance, very, very difficult to qualify for that exception. But the second exception is the short-term rental exception, which only requires 100 hours that's dedicated towards that activity, and that the average stay of your tenant in your property is 7 days or less. And then finally, ultimately, you have to be the one who's working the most in that particular business, meaning no one else is engaging more in that business than you are. But if you meet one of those qualifications, those exceptions to the passive activity loss rules, you're able to pull from the passive side those losses and apply them against your non-passive income, which is a powerful, powerful tax reduction strategy. Business owners from all across the country constantly have questions just like these. Questions that are literally on the top of mind of so many. And so many, though, have nowhere to go to get answers, at least in a fashion that is easy to consume and more so, easy to implement. So what do you do? What do you do in order to help improve your probability of taking the information that you learn and putting it into action? Well, the number one thing you could do is make sure that you become part of a community that holds you accountable to doing just that. I have such a community. It's called the Up-Level Community. If you haven't checked it out yet, you definitely should, because it is an entire ecosystem filled with business owners just like you who are all interested in taking your lives and your businesses to the next level. If you're interested, go ahead, jump in, check it out. I can't wait to see you on the inside.